Imagine stepping into a time machine. Not really to change history, but maybe just to gain some timeless wisdom. Wisdom that could really reshape your financial future.
Yeah, or maybe put another way, like having a powerful shortcut.
Right, a shortcut to truly understanding how to navigate, well, the often unpredictable and, let's be honest, sometimes just bewildering waters of the stock market.
Hmm.
That's pretty much what we're aiming for today.
And we're doing that by taking a really deep dive
Yeah.
into, one of the most foundational and influential books ever written about investing. Benjamin Graham's The Intelligent Investor.
Yeah, and this isn't just some, dusty old textbook sitting on a shelf.
Not at all. It's really a living, breathing guide. It's been thoughtfully updated with some incredible insights, especially from Jason Zweig, the financial journalist.
Brilliant guy.
And, of course, it's got commentary from someone you might just recognize, Warren Buffett. It really does stand the test of time.
So, our sources for this deep dive are specific bits from that definitive edition of The Intelligent Investor. Graham's original work, plus Zweig's modern commentary.
Yep.
And our mission today is pretty clear. We want to pull out the fundamental principles, those enduring lessons, and the practical wisdom Graham laid out, and show you precisely how they apply even today in this incredibly complex, super fast-moving financial world.
Which it definitely is.
Right. We want to illustrate why these principles are still absolutely essential for anyone looking to build wealth intelligently, without feeling totally overwhelmed by all the information, all the noise.
There's so much noise.
So much noise. Get ready for some hopefully genuine aha moments because we're about to unpack some truly foundational stuff. Wisdom that's guided, well, generations of successful investors.
Let's do it.
Okay, so let's start by really digging into this idea. What does Graham actually mean by an intelligent investor?
Yeah, that's a perfect place to start.
Because it has absolutely nothing to do with your IQ score or your academic background, right? Your SAT scores don't matter here.
Nope. Zero.
What's really fascinating, and I think this really sets the stage, is Graham describing this intelligence as, and I'm quoting here, a trait more of the character than of the brain.
Character, not brain power.
So it's not about being the smartest person in the room, is it? It's something deeper.
It's profoundly deeper. And that immediately brings up a really crucial question for anyone starting out or even experienced investors. What kind of character traits are we actually talking about here?
Right. What does that look like?
Well, Graham defines it pretty simply, but it's powerful. He says it's about being patient, disciplined, and having this, insatiable eagerness to learn.
Okay, patience, discipline, learning.
But the really vital part, the one that kind of underpins everything else, is the ability to harness your emotions.
The emotions, that's the hard part.
It really is. It means thinking for yourself rather than just, blindly following the crowd. Whether that crowd is euphoric and buying everything.
Or panicking and selling everything.
Exactly. It's about mental fortitude. Resisting that urge to get swept up in the latest market craze. Or, maybe even more importantly, resisting the urge to succumb to fear and sell when everyone else is hitting the panic button. It's about self-awareness. In the face of all that financial temptation and fear, this emotional mastery, that's really what separates the intelligent investor from the speculator.
And that emotional mastery, that brings us right to Graham's, absolute core distinction. And this is where it gets really interesting for me.
Yeah, this is fundamental.
Because he draws such a clear, almost unyielding line between investment and speculation.
Very sharp line.
And he felt this distinction had pretty much disappeared on Wall Street by his time. And, well, if we're being honest, it's certainly still pretty blurry today, wouldn't you say?
Oh, absolutely. Blurred, maybe even erased in some corners.
It seems like almost everything gets called investing now, even when it's clearly, well, something else entirely.
Precisely. And Graham's definition of an investment operation is so carefully crafted. It's one which, and again quoting, on thorough analysis promises safety of principle and a satisfactory return.
Okay, thorough analysis, safety of principle, and satisfactory return. Those are the key ingredients.
Exactly. The emphasis is really on thorough analysis and safety of principle. Anything else, he argues, just with stark clarity, is speculation.
He doesn't mess around with that.
No, he's incredibly blunt about it. He likens speculation to a casino or betting on horses, places where, quote, the house always prevails in the end against everyone who tries to beat the house at its own speculative game.
Ouch.
Yeah. He even highlights reckless investors as a, quote, laughable contradiction in terms something like spendthrift misers.
Spendthrift misers. I like that. It's an oxymoron, right? Because investing needs prudence. Recklessness is the opposite.
Exactly. It just doesn't compute for him. Genuine investing requires that careful thought, that prudence.
And he really doesn't pull any punches when illustrating the dangers of that speculative mindset, does he?
Not at all.
He issues this very stern warning against people chasing those hot common stock issues, or maybe even more dangerously, operating on margin.
Yeah.
You know, borrowing money to try and boost returns and losses.
Right. Leveraging up, super risky.
He states it pretty directly. Everyone who buys a so-called hot common stock issue or makes a purchase in any way similar thereto is either speculating or gambling. He doesn't really mince words there.
He really doesn't. And that clarity is just so important.
Yeah.
Speculation, he admits, yeah, it can be a lot of fun while you are ahead of the game.
Sure, there's a thrill.
There's definitely a thrill, that sense of quick gratification. But he unequivocally states it's the worst imaginable way to build your wealth over the long term.
The worst imaginable way. Wow.
Yeah. It's basically a zero-sum game, often even negative sum after you factor in fees and taxes.
Right. Someone's losing.
Someone's losing. But by stark contrast, investing, true investing, he says, is a unique kind of casino one, where you cannot lose in the end so long as you play only by the rules that put the odds squarely in your favor.
Okay, so you're playing a different game entirely, with different rules.
Completely different game. And then he draws this really clear economic line in the sand, stating that people who invest make money for themselves. People who speculate make money for their brokers.
Ah, that really tells you who benefits from all that frantic trading, doesn't it?
It certainly does. It's a powerful incentive for the brokerage industry, but often, well, disastrous for individuals caught up in it.
So what does this foundational distinction, investment versus speculation, what does it ultimately mean for us, for you, the listener?
Yeah, what's the takeaway?
It feels like a fundamental call to self-awareness, doesn't it? To truly honestly know if you're playing a long game, building real wealth with principle and patience, or if you're just trying to get lucky, a quick flip, a speculative bet. That distinction for Graham seems absolutely paramount.
It is, because it determines not just your potential financial outcome, but your whole approach, your mindset, your temperament. Everything flows from that.
Right.
And if we connect this to the bigger picture, Graham consistently emphasizes the undeniable role of history in financial markets.
Ah, yes.
He frequently quotes Santayana, reminding us that those who do not remember the past are condemned to repeat it.
Classic quote.
And he argues this is especially, almost painfully true for financial markets, where historical patterns, human reactions, even over decades, they're just crucial.
So history isn't just like a record, it's a teacher.
A constant demanding teacher, yeah. Offering invaluable lessons, but only if we actually choose to listen.
And he was remarkably good at applying those lessons himself, wasn't he? Looking at history to understand his present.
Incredibly prescient. He was famously struck by his own certainty that, quote, sooner or later, all bull markets must end badly.
Prophetic words.
And we saw this play out in vivid, painful detail, didn't we? The wild, almost euphoric bull market of the late 1990s, all driven by tech stocks.
The dot-com boom.
Followed eventually by that brutal bear market of the early 2000s, where so many of those high flyers just crashed and burned. As Jason Zweig's commentary highlights, that period just validated Graham's predictions with uncanny, almost chilling accuracy.
It really did.
Absolutely. And Graham didn't just speak generally. Sometimes he foresaw specific market movements. He looked ahead and accurately predicted the, quote, catastrophic bear market of 1973-1974.
Wow, that was a bad one.
A really bad one. U.S. stocks lost a staggering 37% of their value, a truly devastating blow for many investors.
Yeah.
And he observed that the 1969-70 market shrinkage should have, by all rights, dispelled that dangerous illusion.
What illusion was that?
The illusion that leading common stocks could be bought at any time and at any price, with the assurance not only of ultimate profit, but also that any intervening loss would soon be recouped.
Ah, the buy any time myth.
Exactly. That, Graham concluded with his typical directness, was simply too good to be true. Such assumptions, they often lead to really painful corrections.
He also looked at the havoc caused by the 1961-62 break in secondary stocks, right? When smaller companies got hit hard.
Smaller, lesser-known companies experienced significant drops. But what was particularly novel then, he pointed out, was that investment funds, which you'd think would be more conservative.
Right, the professionals.
Yeah, they had made large commitments in highly speculative and obviously overvalued issues.
Even the funds got caught up.
Even the funds. And this just underscored for Graham and really for us today that unchecked enthusiasm on Wall Street almost invariably leads to disaster. The timeless warning feels just as relevant, maybe even more so, in today's super rapid-fire market cycles.
Yeah, it really does. The lesson seems clear. Past market mistakes, past follies, they're almost always just waiting to be repeated if we forget the lessons they taught us.
That's the constant danger.
All right, so if we understand the intelligent investor's mindset, that mix of character, emotional control, and we get that crucial difference between real investment and just risky speculation.
Mm-hmm. Got the foundation.
How do we actually put this into action? In our portfolios, Graham doesn't just leave us hanging there, does he?
No, he's very practical. He presents two distinct paths for portfolio policy. There's the defensive, or you could say passive investor.
Okay.
And then there's the enterprising or aggressive investor.
Defensive and enterprising. Let's start with the defensive approach. Graham suggests that's probably suitable for most people, right?
That's his strong recommendation, yes. The core principle for the defensive investor is really a disciplined division of funds, splitting your money between high-grade bonds and carefully selected common stocks.
Okay, bonds and stocks. But how much in each?
He suggests a fundamental guiding rule, one that gives you both flexibility and protection. Never allocate less than 25% or more than 75% of your funds to common stocks.
25 to 75% stocks.
Right, with a corresponding inverse range held in bonds. So if stocks are 25%, bonds are 75%, and the other way around.
Makes sense. Balanced.
Exactly. A standard division, he notes, would just be an equal split, 50-50. The underlying idea is to have this structured, balanced allocation that you actually commit to.
So you don't just swing wildly based on market news or how you're feeling that day.
Precisely. Avoid those extreme swings based on, fleeting market sentiment or emotional reactions. It's really all about stability and consistency for the defensive investor.
And what kind of stocks should this defensive investor be looking at? It's clearly not about chasing the latest hot stock or trying to pick the next Apple or Google, which, let's face it, is what so many new investors are tempted to do.
Absolutely not. That's the speculator's game. For stock selection, the defensive investor should focus exclusively on, quote, large, prominent, and conservatively financed corporations.
Big established companies.
Yeah, and ones that have paid continuous dividends for a considerable number of years. These aren't speculative startups. They are established, financially sound businesses.
Okay, and he gives some actual numbers for that conservatively financed part, right?
He does. He provides specific, quantifiable criteria. For industrial companies, the common stock's book value should represent at least half of the company's total capitalization.
Half equity for industrials.
And for railroads and public utilities, he sets that threshold a bit lower, at a minimum of 30%.
Okay, so what does that ratio actually tell you, the listener? Why is that important?
It signifies that a significant chunk of the company's assets are funded by equity, basically. Money put in by shareholders, rather than relying too heavily on debt.
Ah, so they're not drowning in debt.
Exactly. It's a strong indicator of financial stability. It shows the company has a solid cushion, a buffer, even if economic conditions turn sour.
And he's pretty cautious about what were then called growth stocks, right? Like the IBMs or Texas Instruments of his day, even though they turned out to be huge winners for some early investors.
Yeah, he acknowledges their phenomenal rewards for early holders, but Graham still cautions that such stocks and their modern equivalents, think Microsoft or Cisco back in the day, are too uncertain and risky a vehicle for the defensive investor.
Too risky, even the big successful ones.
Yeah, he points out that IBM, despite its incredible long-term growth, still lost 50% of its market price in a 6 months decline back in the early 60s, and then again around 1970.
Wow, 50% drop.
And more recently, think about Cisco, a tech darling of the late 90s. It lost 76% of its value between 2000 and 2002.
It's 76%. Ouch.
Yeah. So for the defensive investor, that kind of volatility, the potential for such steep drops, even in what seem like fundamentally sound companies, just makes them unsuitable. The defensive investor has to prioritize safety and consistency over those potential explosive but really unpredictable gains.
So for you listening, it sounds like it's about slow and steady growth, not the flashy but often short-lived wonders that you might get with picking individual stocks.
Exactly. Graham says the average investor can no more expect to accomplish this than to find money growing on trees.
Yeah, good luck with that.
He really emphasizes that diversification is absolutely key here. He notes, as you own more stocks, the damage any single loser can cause will decline, and the odds of owning all the big winners will rise.
Spreading the risk.
Precisely. And Jason Zweig's commentary builds right on this, suggesting that a total stock market index fund is probably the ideal choice for most investors in today's world.
Why is that?
Because it inherently gives you that broad, instant diversification without needing to pick individual stocks at all. It's the ultimate kind of set it and forget it approach for the defensive investor. Takes the guesswork out.
Okay, that makes sense for the stock side. What about the bond component? That's equally critical for the defensive portfolio, right?
Absolutely, just as critical. The choice here involves understanding the differences between taxable bonds, like corporate bonds,
Right.
and tax-free municipal bonds,
Yeah.
as well as thinking about shorter versus longer-term maturities.
Okay, so taxes and time horizon matter.
Big time. He gives an example. Back in January 1972, a 20-year grade A corporate bond yielded 7.5%, while prime tax-free municipal issues yielded 5.3%. Graham actually walks through the math of comparing these yields against your own individual tax bracket to figure out which one is better for you after taxes.
That's a really important calculation most people probably skip.
They often do. Historically, he also liked U.S. savings bonds like Series E or H. They were excellent for safety and offered a decent return, like 5% yield back then, with a guaranteed resale value. So you got liquidity and principal preservation.
And what about inflation? That's always a big worry for investors, especially lately. What does Graham recommend for the defensive investor to protect against rising prices? Bonds seem like they might struggle there.
That's a really keen observation. Bonds can definitely lose purchasing power to inflation. Graham acknowledges, quote, "There's no certainty that a stock component will insure adequately against such inflation.
Okay, no guarantees.
But," he strongly states, "it should carry more protection than the bond component."
Why is that?
His reasoning is pretty straightforward. Stocks represent ownership in actual businesses. And businesses, over the long run, often have the ability to raise their prices and grow their earnings to offset inflationary pressures.
Unlike bonds, which just pay a fixed amount.
Exactly. Unlike fixed income bonds, whose purchasing power just erodes over time with inflation. Now, Jason Zweig's modern commentary here is super practical. He suggests that TPS Treasury inflation-protected securities.
Ah, TPS. Heard of those.
Yeah, they're an ideal substitute for the proportion of your retirement funds you would otherwise keep in cash. Especially good inside tax-deferred accounts like an IRA or 401k, where those inflation adjustments aren't immediately taxed each year.
Okay, good tip.
But he emphasizes, don't try to trade pesos. They can be volatile short-term. They work best as a permanent, lifelong holding. He argues that allocating at least 10% of your retirement assets to TPS is an intelligent, effective way to keep a portion of your money absolutely safe and really beyond the corrosive reach of inflation.
That's very clear advice. He also championed a technique that's pretty well known now, dollar cost averaging. Can you break that down for us? And maybe more importantly, how does it help the intelligent investor manage those tricky emotions we talked about?
Absolutely. Dollar cost averaging is actually deceptively simple.
Okay.
It just means investing the same fixed amount of money, say $100 or $500 each month or each quarter, no matter what the market is doing. Up, down, sideways, doesn't matter.
Same amount, regular schedule.
Right. This ensures that you automatically buy more shares when the market price is low.
Because your fixed dollars buy more shares then.
Exactly. And you buy fewer shares when the market price is high. Over time, this disciplined approach leads to a satisfactory overall price for your holdings. It smooths out the peaks and valleys of market volatility.
And it's easy to set up.
Super easy. It can be easily automated through mutual funds or most brokerage firms now, making it truly out of sight, out of mind, which is really its genius.
Ah, the psychological benefit.
Huge psychological benefit. Graham and Zweig see this not just as an investment technique, but as a powerful psychological tool. It forces you to, quote, drop any self-delusion that you know where stocks are headed.
Which none of us do.
Right. And perhaps more crucially, you take away the market's power to upset you. By automating your purchases, you remove the emotional guesswork. You remove that temptation to try and time the market, which is almost always a losing game for individuals. It cultivates patience and discipline without you even having to think about it.
Okay, so that's the defensive investor. Balanced, diversified, disciplined, uses dollar cost averaging, focuses on safety and steady returns. Now, what about the other path? The enterprising investor.
Right. Now, in stark contrast to that defensive approach, the enterprising investor takes a fundamentally different path. This path requires, quote, considerable knowledge of security values.
Okay, more work involved.
A lot more work. It's akin to running a full-fledged business yourself, rather than just passively participating in the market. Graham makes it crystal clear. This is not some middle ground. It's a full commitment. It demands substantial time, diligence, and real intellectual effort.
So it's not for everyone.
Definitely not. As he puts it, the average security owner lacking this specific dedication should strongly just elect the defensive classification. They simply don't have the time, the determination, or the unique, quote, mental equipment required to really embark upon investing as a quasi-business.
Okay, so this group, maybe our listener who really loves to learn, loves to dig deep, analyze things, they might be tempted by this more active path.
Could be.
If they choose to become an enterprising investor, if they decide to treat investing like their own business, what does Graham say they should focus on? Where do they look?
The enterprising investor's focus is really on unearthing value, where other people just aren't looking. They search for issues that are not popular on Wall Street.
Out of favor stocks.
Exactly. Stocks that may be undervalued because of lack of interest or unjustified popular prejudice.
Yeah.
One key strategy Graham highlights is buying common stock that sells for, get this, less than the company's net working capital alone after deducting all prior obligations.
Wait, less than net working capital, what does that even mean?
It means, astonishingly, you're effectively paying nothing at all for the fixed assets. The factories, the machinery, the land, the brand name, you get all that for free.
That sounds almost too good to be true. Can you give us an example, maybe a hypothetical one? How would a listener even spot that?
Okay, imagine a company. It's liquid assets, cash, inventory, money owed to them, accounts receivable. Total $10 million.
Okay, 10 million liquid.
And let's say all its debts, short-term and long-term, add up to $6 million.
Okay.
So its net working capital is $4 million, right?
Yeah.
10M, 6M.
Got it. $4 million net working capital.
Now, what if the entire company's market value, what you'd pay to own every single share, is only, say, $3 million?
Whoa.
You're effectively buying $4 million in easily sellable assets for just $3 million, meaning you get the factory, the equipment, the brand name, everything else for free, plus there's a built-in $1 million profit just from the liquid assets alone.
That's incredible. Does that actually happen?
It does, or at least it did more often in Graham's time. He cites real-world examples like National Presto Industries back in 1970. Despite its profits going up, its price fell to less than 4 times record earnings and, crucially, less than its net current asset value. Another classic he mentions is General Motors selling at less than 30 in 1941, which he calculates was equivalent to only 5 for the 1971 shares, while earning $4 and paying $3.50 in dividends. This, Graham argues, powerfully showed the wisdom of having courage in depressed markets and applying this deep value, almost scavenger-like approach.
That's incredibly insightful, finding genuine, tangible value where others are just completely overlooking it, often because of fear or pessimism. What about special situations? These sound maybe more complex.
They are indeed more complex. Special situations cover categories like intersecurity arbitrages, payouts or workouts and liquidations, and certain kinds of protected hedges.
Okay, sounds technical.
Yeah. The most typical case, and maybe the most recognizable one, is a projected merger or acquisition, where one company announces it will buy another company for a specific price, say $100 per share.
Right, M&A deals.
Exactly. If the target company stock is trading at, say, $95 after the announcement, an arbitrager might buy shares of that target company, betting that the deal will actually close, allowing them to capture that $5 difference per share.
Ah, the spread.
Right, the merger spread. While these can promise attractive annual returns, sometimes 20% or more, they are inherently complex. They often require specialized knowledge, real speed, and considerable capital.
And maybe less common now.
Graham noted that the profitability of these special situations lessened even in his time because of too much competition, more people trying to do it, and the multiplication of obstacles to mergers, things like regulatory hurdles or companies fighting takeovers.
Okay.
Jason Zweig's commentary is very direct here. He warns that merger arbitrage is wholly inappropriate for most individual investors today. It's just too complex. You need immense diversification across many deals to manage the risk of one falling through, and the professionals operate incredibly fast.
Got it. Not for amateurs.
Definitely not.
Yeah.
Graham also notes that no true distinction exists between bonds and common stocks in this specialized area, because your return isn't tied to the underlying business performance. It's tied purely to whether or not the deal closes successfully.
Interesting point.
Yeah, and what's truly fascinating here is just how counterintuitive these enterprising strategies are. They go directly against what Graham calls the ingrained and pernicious maxim of Wall Street.
Which is?
That stocks should be bought because they have gone up and sold because they have gone down.
Ah, the momentum chasing. Buy high, sell higher, or sell low.
Right. That maxim, driven by momentum and, frankly, fear of missing out, is what fuels speculative bubbles. Instead, the intelligent investor's enterprising path is all about a disciplined, analytical approach to uncover true intrinsic value, often in companies that are out of favor or maybe just going through a temporary rough patch.
So rather than chasing those hot stocks or relying on, forecasts which are often wrong,
Yeah, notoriously unreliable.
it's about deep, maybe even painstaking analysis, looking for opportunities where others aren't looking, often because of, like you said, popular prejudice or temporary market conditions that have pushed a good business's price way down.
Exactly. That's a truly active, almost detective-like approach. It demands significant dedication and a very specific temperament.
Okay, this next concept is easily one of Graham's most famous, maybe most beloved, and frankly just most entertaining contributions to how we think about investing.
Ah, I know where you're going.
He gives us the timeless parable of Mr. Market.
Yes? Mr. Market.
It's such a vivid, almost comical metaphor for how the stock market can behave, isn't it? It really brings the whole abstract market concept to life.
It absolutely does. And the beauty of the parable is really in its simplicity and its profound truth. Imagine, if you will, that you own a piece of a private business. Let's say it's a local bakery or a small factory.
Okay, got it. My business.
And you have a partner in this business named Mr. Market. Now, every single day, without fail, Mr. Market shows up at your door, like a persistent, maybe slightly annoying salesperson.
Uh-huh.
And he offers to do one of two things: either buy your share of the business from you or sell you his share.
Every day.
Every single day. But what's truly unique about Mr. Market is his personality. He's, let's say, emotionally volatile.
Uh-huh. Sounds familiar.
Right. Sometimes he's wildly optimistic, almost manic, just brimming with enthusiasm, convinced the future is endlessly bright. And on those days, he offers a ridiculously high price for your share.
Okay, high price when he's happy.
But other times he's deeply pessimistic, suffering from fits of depression, convinced the world is ending, maybe because his own business prospects look bleak, or just the general economy seems terrible. And on those days, he quotes a ridiculously low price for your share. He practically begs you to sell to him at that low price.
So he's moody. Very moody.
Extremely moody. Manic depressive, perhaps.
And the genius of this parable is that it highlights the intelligent investor's choice, doesn't it? You don't have to deal with this guy's moods.
Exactly. That's the crux of it. The intelligent investor possesses this powerful advantage. They can take advantage of the daily market price or leave it alone, as dictated by his own judgment and inclination.
You're in control, not him.
You are in control. Graham stresses with such liberating clarity, you do not have to trade with him just because he constantly begs you to.
Mm-hmm.
This is where that emotional discipline we talked about comes right back in.
Right. Resist the urge.
Resist the urge. Essentially, Graham says, price fluctuations have only one significant meaning for the true investor. Only one.
Which is?
They provide him with an opportunity to buy wisely when prices fall sharply and to sell wisely when they advance a great deal.
Buy low, sell high. Seems simple, but hard to do.
Seems simple. But crucially, at other times, when Mr. Market's prices aren't particularly crazy high or low, Graham says you will do better if he forgets about the stock market.
Just ignore it.
And pays attention to his dividend returns and to the operating results of his companies. Focus on the business, not the manic partner.
I love that. And Jason Zweig adds that great image, right?
He does. It's unforgettable. He tells us to imagine a huge banner unfurling on the New York Stock Exchange when stocks plunge, reading, sale, 50% off.
Haha. Change your perspective.
Totally changes your perspective. It's a powerful reminder that low prices are opportunities to acquire value, not reasons to panic and run for the exits.
So Mr. Market is a tool, basically, a resource to be used shrewdly when it suits you, not some volatile master you have to obey.
Exactly.
It's fundamentally about emotional discipline again, controlling your own reactions to the market's often erratic behavior rather than letting the market's whims control you. This is precisely where that character Graham mentioned earlier, the patience, the discipline, the independent thought, really gets tested, right? It's like a daily test of your temperament.
It really is, which immediately raises that important question. If Mr. Market offers such clear opportunities, buy low from the depressed guy, maybe sell high to the manic guy, why do so many investors struggle? Why do they fall prey to his moods so easily?
Yeah, why is it so hard?
Graham argues that the primary cause of failure is that they pay too much attention to what the stock market is doing currently.
Just watching it too closely.
Way too closely. This relentless fixation on the short-term movements, the endless stream of news, the ticker flashing, the seemingly authoritative forecasts from experts, it's a dangerous, almost irresistible trap for the unwary investor.
And history is just absolutely littered with examples of these forecasting failures, isn't it?
Oh, completely littered.
It seems like every market peak brings out a choir of bulls, just as every trough brings out the doomsayers, and they're usually both wrong in the long run.
It's uncanny. Consider the cautionary tale of 1973. Alan Greenspan, who was then a top financial forecaster.
Future Fed chair.
Right. He urged investors to buy, famously declaring it was, quote, very rare that you can be as unqualifiedly bullish as you can now.
Oh, boy. What happened next?
What followed immediately? The catastrophic bear market of 1973-74. Devastating for anyone who listened to that bullish call.
Wow. Timing is everything or nothing.
Or nothing, exactly. Or recall March 2000, the very day the NASDAQ hit its all-time high, 548.62, fueled by the dot-com bubble.
Peak insanity.
Peak insanity. Market strategists were confidently predicting it would soar to 6,000, maybe even higher. Instead, it crashed spectacularly, plummeted all the way down to 1114.01 by October 2002.
Incredible wipeout.
Incredible. Graham wisely warned that any approach to money-making in the stock market, which can be easily described and followed by a lot of people, is by its terms too simple and too easy to last.
If it seems too easy, it probably won't work for long.
Exactly. He even quotes the philosopher Spinoza to emphasize how hard true excellence in investing is. All things excellent are as difficult as they are rare.
It takes work. Beyond just bad forecasts, Graham and Zweig also dig deep into the psychological biases that trip us up, even smart investors. It sounds like our own brains are sometimes working against us, setting these invisible traps.
They absolutely are. Our wiring isn't always helpful for investing. The brilliant psychologists Daniel Kahneman and Amos Tversky, true pioneers in behavioral economics.
Prospect theory, guys.
Exactly. They demonstrated through the research that the pain of financial loss is more than twice as intense as the pleasure of an equivalent gain.
Loss aversion hurts more to lose than it feels good to win.
Way more. This visceral, totally disproportionate aversion to loss often leads many people, just terrified of the prospect of any further loss, to sell out near the bottom, or maybe just freeze like a deer in headlights and refuse to buy more when stocks are actually cheap.
Because they fear the pain of more loss more than they desire the pleasure of potential future gain.
Precisely. It's like that classic self-defeating pattern we see all the time. Buy high, sell low. Completely driven by raw emotion, fear, and greed, rather than any kind of rational analysis.
So counterproductive.
Totally.
Yeah.
Another pervasive bias is overconfidence, especially something called home bias.
Home bias. What's that?
It's the habit of sticking just to what's familiar, even something as close to home as your own company's stock.
Loading up on company stock in the 401k.
Exactly. The tragic stories of employees at Enron, Global Crossing, WorldCom, they put nearly all their retirement assets into their own company's stock, only to be completely wiped out. Stark, painful examples of this bias.
Devastating.
Yeah. As Zweig notes, insiders often possess only the illusion of knowledge, not the real thing. They think they know more than they do.
Illusion of knowledge. Good phrase.
Furthermore, people often dramatically ignore percentages when market numbers get reported in absolute points. They might panic when the news shouts, the Dow is down 100 points.
Yeah, sounds scary.
But they forget that if the Dow is at, say, 8,000 points, 100 points is only a 1.2% drop. Hardly catastrophic, right? It's like shrieking that the temperature dropped from 81 degrees to 80 degrees.
Yeah, perspective matters.
Perspective is crucial. Graham concludes that the typical investor would be better off if his stocks had no market quotation at all.
No price sticker.
No price sticker.
Right.
For he would then be spared the mental anguish caused him by other person's mistakes of judgment. Without those daily quotes constantly flashing, you'd be forced to focus on the actual business results, not the fleeting sentiment reflected in the price.
Fascinating idea. Okay, so beyond market swings and psychological traps, Graham also digs into the, let's say, the nitty-gritty of corporate financials. He seems pretty skeptical about reported earnings and financial statements sometimes. Like, what you see isn't always what you get.
Oh, extremely skeptical. What's truly fascinating here is Graham's deep, almost cynical view of reported earnings and what companies choose to present in their financial statements.
Cynical, but maybe realistic?
Perhaps realistic, yeah. He warns against accounting factors of one kind and another that may impair the true comparability of the numbers. He saw, very clearly, many clever tricks companies could use to obscure their true financial health, maybe inflate earnings temporarily or mask underlying problems.
So accounting games.
Accounting games, accounting shenanigans. He understood that numbers on a page could be manipulated to tell a desired story rather than the objective truth.
So what were some of these classic tricks he pointed out? And do we still see them today?
Oh, absolutely, they're timeless. He points to things he called special charges. He gives these amusingly detailed examples like AMF Corps' $2.357 million in charge-offs for stuff like closing operations, reorganizational expenses, liquidating a failed ski boot operation.
Okay, one-time costs.
Supposedly one-time costs.
Yeah.
Graham notes these, while seeming legitimate on the surface, could be used strategically and often never be reflected in the per-share earnings that Wall Street analysts tend to focus on.
Hidden from the main number.
Exactly. He also describes the infamous big bath or kitchen sink accounting.
The big bath.
Yeah, where companies pile up as many charges and write-offs as possible into one particularly bad year. This makes that year look absolutely terrible.
Right.
But then it makes the subsequent year's earnings look artificially better by comparison. It sets a much lower bar for future growth.
Clever, but deceptive.
Very. Other tactics include manipulating depreciation methods. He gives the example of Trainco boosting its reported earnings by nearly 20% simply by switching back to straight-line depreciation rates.
Just changing an accounting assumption.
Just changing an assumption. Or things like repeated non-recurring inventory write-downs. He mentions Micron Technology booking inventory write-downs for 6 consecutive quarters.
6 quarters? That doesn't sound very non-recurring.
Exactly. For the intelligent investor, a non-recurring charge that keeps recurring like clockwork is a massive red flag. Something's not right.
He also mentions the OPM addict. That's a pretty colorful term. What's that about? How does that relate to these accounting games?
Yeah, OPM addict. OPM stands for other people's money.
Ah, okay.
An OPM addict is Graham's term for a company that relies way too heavily on external funding, constantly borrowing more debt or selling new stock just to keep the lights on or fund growth, rather than generating sufficient cash from its own core business operations.
So they're living on borrowed time or borrowed money.
Pretty much.
Yeah.
While raising capital is normal, an OPM addict uses it almost like a drug. This influx of external cash can make a sick company appear to be growing, even if its underlying businesses are not generating enough cash to stand on their own.
Ah, masking weakness.
Exactly.
Yeah.
Global Crossing and WorldCom from the early 2000s are cited as clear, devastating examples of this, using massive amounts of debt and stock issuance to fund unsustainable expansion that eventually collapsed.
Right, huge flameouts.
Huge. Graham criticizes what he calls opaque accounting in general, where those non-recurring charges keep recurring, where extraordinary items seem remarkably ordinary, where trendy acronyms like EBITDA get pushed ahead of more robust measures like actual net income.
EBITDA earnings before interest, taxes, depreciation, and amortization. Often used to make earnings look better.
Often, yes. Or where companies use pro forma earnings, basically.
Yeah.
Adjusted earnings to try and cloak actual significant losses under standard accounting rules.
Jake by. So lots of ways to fudge the numbers.
Lots of ways. The historical case of Quest Communications, which ended up overpaying $320 million in federal income tax because of massive accounting restatements it had to make later, just highlights the real-world and often painful consequences of these deceptive practices. Shareholders ultimately pay the price.
So it's really not just about looking at the headline numbers, is it? It's about critically analyzing how those numbers were produced. Were they designed to be transparent or, like you said, opaque? It's about critical thinking, almost like financial forensics.
Exactly. Forensic analysis. That's crucial for understanding a business's true health, not just the story management wants to tell.
Right. And that leads us to another really important question for you, the listener. How do companies actually manage their wealth? Specifically, the cash they generate, and whose interests are truly being served by those decisions.
Yeah. Who benefits?
Graham, always championing the common shareholder, emphasizes that the burden of proof is really squarely on the company to show that its shareholders are better off if it doesn't pay a dividend.
Interesting perspective. Prove why you shouldn't give us the cash.
Exactly. He noted with some concern that the payout ratio, the percentage of earnings paid out as dividends had dropped significantly. It went from maybe 60-75% in his earlier days down to just 35-40% by the late 1990s.
So companies were holding on to more cash.
Holding on to a lot more cash, which meant more earnings were being retained. But Graham questioned, were they being retained wisely?
Good question.
And he particularly called out companies that were accumulating these, like, mountains of cash that weren't really being put to good use, ultimately not benefiting the shareholders much.
Yes, this was a significant concern for him. He saw companies like Oracle, which had piled up $5 billion in cash. Cisco had $7.5 billion, and Microsoft had amassed a truly staggering $38.2 billion.
$38 billion.
A figure that was rising, Swag calculated, by over $2 million per hour in the early 2000s.
Mind-boggling.
Mind-boggling. Graham stated that so long as this surplus cash remains with the company, the outside stockholder gets little benefit from it. It often just sits there, maybe earning low interest, leading to lousy returns for investors compared to what the company could earn in its business or what investors could do with the cash themselves.
So dead money sitting on the balance sheet.
Pretty much. Now, Microsoft, to its credit, did eventually address this. They finally declared a regular quarterly dividend, likely responding to shareholder pressure and the sheer logic of putting that massive capital hoard to work for its owners.
He's also quite critical of stock splits, isn't he? Describing them as often just superficial gestures. What's his issue with a company splitting its stock? Seems harmless.
He sees them often as little more than sales gimmicks that, quote, treat their investors like dolts.
Dolts, haha.
Yeah, his point is clear and logical, really simple. 2 shares of a stock at $50 are not worth more than 1 share at $100.
Right, the total value is exactly the same. You just have more slices of the same pie.
Exactly the same. He calls this kind of thing, where something seems beneficial but isn't, an example of the most dangerous untruths are truths slightly distorted.
Subtle deception.
And he connects this directly to management incentives. Executives, especially those with lots of stock options, often have a vested interest in pushing for stock buybacks over paying dividends.
Why is that? Buybacks versus dividends.
Because stock options increase dramatically in value with price fluctuations, with volatility. Dividends, on the other hand, by distributing cash out of the company, tend to dampen that volatility. Lower volatility often means lower potential upside for options.
So options holders prefer buybacks to juice the price and volatility.
Often, yes. This can lead to buybacks that actually waste the resources of the outside shareholders, especially if the stock is bought back at inflated prices, merely to prop up the stock price for the benefit of executives' options, rather than returning capital productively via dividends or reinvesting it wisely in the business itself.
Wow. It really sounds like we, as investors, need to be incredibly vigilant. We can't just take management's word for things or get swept up in market buzz or accounting tricks.
Constant vigilance is key.
We have to critically analyze their actions, really try to understand their incentives, and make sure, as best we can, that their interests truly align with ours as long-term shareholders.
That alignment is crucial, but often elusive.
Okay, we've covered a lot of ground today. We've talked about the mindset of an intelligent investor, navigating market psychology, dissecting corporate financials.
Been quite a journey through the book.
But if there's one single concept, one overarching principle that Graham really wants us to take away from the intelligent investor, it is unequivocally the margin of safety.
Absolutely. That's the bedrock.
He explicitly states, this is the thread that runs through all the preceding discussion of investment policy. It's like the central pillar holding everything else up, isn't it?
It absolutely is the central pillar. It's the investor's secret weapon, maybe the most important concept in the whole book. If we connect this to the bigger picture, the margin of safety is essentially the, quote, difference between the percentage rate of the earnings on the stock at the price you pay for it and the rate of interest on bonds.
Okay, earnings yield versus bond yield.
Yeah, in simpler terms, it's your buffer. It's your protective cushion against unsatisfactory developments, things going wrong. Or if your initial calculations about a company's value turn out to be, well, a bit off.
Because they often are, right? The future's uncertain.
Exactly. It acknowledges that the future is uncertain and that even the most careful analysis can have flaws. Graham illustrates this by noting that back in 1965, a typical stock trading at maybe 11 times earnings had an earnings yield of about 9%. Bonds were yielding maybe 4%. That created an impressive margin of safety of over 100%.
Wow, big buffer.
Big buffer. But by 1972, he observed that favorable difference had pretty much disappeared. Stocks were much more expensive relative to earnings and bonds. Meaning, he grimly noted, you have a negative margin of safety on stocks at that point. Much riskier.
So this margin of safety, it's most evident and maybe most powerful when you're able to buy a security at a real bargain price, right? That's where the safety really comes from, buying cheap.
Precisely. It's most evident in what he calls undervalued or bargain securities, where there's a significant favorable difference between price on the one hand and indicated or appraised value on the other. That difference is your safety margin. That's the cushion you're building in by not overpaying.
Don't overpay. Seems fundamental.
Fundamental, but often forgotten in bubbles. Graham even suggests that things like common stock option warrants, if they were selling at historically low prices, could offer a margin of safety if a thorough study showed there was much more to potentially gain than to lose.
Okay, even for speculative instruments, potentially.
Potentially, with deep analysis. He invokes Pascal's wager, the philosophical argument for believing in God, based on weighing the potential consequences.
Right. Infinite reward versus finite loss.
He applies that logic to investing. In making decisions under conditions of uncertainty, the consequences must dominate the probabilities. We never know the future. Therefore, you must insure against loss if your analysis turns out to be wrong. You have to protect the downside.
Prioritize not losing money.
That's paramount. Many so-called investors who piled 85% or more of their money into speculative.com stocks back in 1999, he notes, tragically ignored this core principle. They effectively took the wrong side of Pascal's wager, betting almost everything on a very low probability, potentially high reward, but also catastrophic loss outcome. They didn't protect their downside.
They ignored the margin of safety completely. Now, this is a fantastic section in the book because Graham, and then later through Jason Zweig's commentary, and of course, Buffett's insights.
Yeah, the super investors part.
Right. They show us that these ideas aren't just, theoretical concepts sitting in a book. They provide really compelling examples of actual, real people who applied these principles diligently, patiently, and achieved truly remarkable market-beating success over long periods.
Yeah, it's proof of concept.
It's not just about what to do, but here's concrete evidence of who has done it successfully and the results they got.
What's truly fascinating here are the examples of what Buffett famously calls the coin flippers from Graham and Doddsville. He's referring to Columbia University, where Graham taught finance.
Coin flippers, meaning they were lucky.
No, quite the opposite. He uses the term ironically. He argues they were not lottery winners. They were investors who consistently beat the market, not by luck, but by systematically applying these core value principles.
Okay. Skill, not luck.
Skill, based on principles. These individuals were chosen, Buffett notes, based on their framework for investment decision-making, their intellect, their character, and crucially, their temperament. Those very traits of an intelligent investor we talked about right at the start.
Back to character.
Back to character. A common thread among all these successful investors was that they assumed far less risk than average.
Yeah.
Precisely because they always demanded that margin of safety. They were, as Buffett says, mentally always buying the business, not buying the stock.
Focusing on the underlying asset.
Exactly. And fundamentally, they all sought to exploit the difference between the market price of a business and its intrinsic value. That gap was their opportunity and their safety net.
So who are some of these legendary super investors that they profile? Give us some names.
Okay, well, one prominent example is Walter Schloss, a true disciple of Graham's, known for his incredibly consistent outperformance over decades. His approach was relatively simple, but highly effective. He bought dozens of stocks, achieving wide diversification, focusing on ones trading at a significant discount from their tangible assets, and then he just patiently waited for the market to recognize their value.
Simple, patient, effective.
Very. Then there's Bill Rowan, another student of Graham's, who later launched the highly successful Sequoia Fund. His fund achieved stellar results, even though it was launched right into a challenging two-tier market in the early 70s, where growth stocks were favored and value stocks were ignored. It proved Graham's methods could work even in difficult market environments.
Resilience of the strategy.
Exactly. And of course, you have Charlie Munger, Warren Buffett's brilliant longtime partner at Berkshire Hathaway. Now, while his portfolio was much more concentrated, holding fewer stocks and therefore much more volatile than Schloss's.
Right. Munger's known for concentration.
It was still based on the same core discount from value approach. Though Munger often focused on higher quality businesses compared to Schloss's cigar butt approach, Munger was willing to accept greater peaks and valleys in his portfolio's value in exchange for potentially greater long-term returns.
Different style, same core principles.
Same core DNA. Another compelling example mentioned is the FMC Corporation Fund. After they consciously decided to convert to using only value-oriented managers back in 1974, their fund ranked #1 in the prestigious Becker survey of large pension funds. They directly attributed this success to selecting managers based on a deep understanding of Graham's value principles.
Wow, clear results from changing the philosophy. It's truly incredible how these diverse investors, with different personal styles, different portfolio concentrations, they all shared those fundamental Graham principles: margin of safety, intrinsic value, emotional control, and achieved such remarkable, sustained success over decades.
It's powerful validation, isn't it? Real-world proof.
It really is.
And this leads us to a truly critical question, maybe a mind-bending one for some. How do these intelligent investors, these super investors, actually view risk?
Ah, the definition of risk.
They fundamentally invert the conventional wisdom taught in most finance classes. Buffett puts it provocatively. If you buy a dollar bill for 60 cents, it's riskier than if you buy a dollar bill for 40 cents.
Wait, buying cheaper is riskier? That sounds backwards.
It sounds backwards to conventional theory. But, Buffett continues, the expectation of reward is greater in the latter case, buying for 40 cents. This sounds completely counterintuitive if you're steeped in modern financial theory, where more volatility, measured by beta, often equates to more risk.
Right, beta equals risk in the textbooks.
But to Graham and Buffett, the greater the potential for reward in the value portfolio, the less risk there is. Because your reward comes from that discount to intrinsic value, and that discount is your margin of safety. Buffett calls the conventional view truly Alice in Wonderland thinking, compared to the common sense of buying things for less than they're worth.
That really does turn the common understanding of risk completely on its head, doesn't it? It ties risk directly back to the price you pay relative to the value you get, your margin of safety.
Exactly. If you're buying something for far, far less than its intrinsic value, you're actively reducing your risk, not increasing it, even if the short-term market price bounces around like crazy.
So volatility isn't risk. Losing money permanently is risk.
Precisely. It's a profound shift from thinking about price fluctuations, the beta, as risk, to thinking about the discount, to intrinsic value as your actual protection, your safety.
That makes so much more sense intuitively.
It does. And Buffett gives a brilliant real-world example, the Washington Post Company back in 1973.
Okay.
The entire company was selling in the stock market for a mere $80 million. But its underlying assets, the Washington Post newspaper itself, Newsweek magazine, several valuable TV stations could have been sold off, even conservatively estimated, for not less than $400 million.
Wow. $80 million market cap, $400 million asset value. Huge gap.
Huge gap. Now, conventional beta, measuring the stock's historical price volatility, would suggest that if the stock price declined further from $80 million, making its market valuation, say, only $40 million, beta would say it just got riskier because its price swings were bigger.
Right, more volatile equals more risky.
But to Graham and Buffett, buying $400 million worth of tangible, income-producing properties for only $40 million is undeniably less risky and offers far, far greater potential reward than buying them for $80 million. Your margin of safety just got enormous as the price dropped further below intrinsic value.
Yeah, that's crystal clear. The risk decreased as the price fell because the value stayed the same.
Exactly. It's a profound shift in perspective.
Yeah.
Risk isn't in the volatility. Risk is in overpaying relative to the underlying reality of the business value.
We've truly seen today how the intelligent investor provides this clear, timeless, and surprisingly practical roadmap for navigating the complexities of financial markets. Doesn't really matter what the latest tech is or the current market fad.
The principles endure.
They really do. It's fundamentally about developing the right character traits, that patience, discipline, independent thought, emotional control we keep coming back to.
The foundation.
It's about diligently distinguishing between true investment, which is built on thorough analysis and safety of principle, and just risky speculation, which really preys on emotion and chasing trends.
Knowing which game you're playing.
Exactly. It's about employing sensible, sustainable portfolio strategies. Whether you choose the defensive path or the more demanding, enterprising one, tailoring it to your own commitment level and temperament.
Right, finding the right fit.
And it's about exercising that healthy skepticism we discuss, understanding accounting nuances, looking critically at management incentives, and always, always insisting on that powerful margin of safety.
Never forget the margin of safety.
These principles, really forged in the fires of market crashes and booms over decades, feel just as relevant today in our crazy digital age as they were when Benjamin Graham first penned them all those years ago.
They really are timeless wisdom, indeed. And Graham reminds us, quite powerfully, that uncertainty and investing are, in many ways, synonyms. They go hand in hand.
Yeah, you can't have one without the other.
Exactly. No one has ever been given the crystal ball, the ability to see with certainty that any particular time is the perfect time to buy stocks. The investing world is inherently uncertain, it's fraught with unforeseen events, unpredictable human reactions, and it always will be.
That's the reality we operate in.
It is. Yet, despite this pervasive uncertainty, Graham says that to be an investor, a true investor, you must, at your very core, be a believer in a better tomorrow.
Optimism required.
A grounded optimism, yes.
Yeah.
You have to have faith in the long-term progress of enterprise, in innovation, and in the underlying value of sound businesses eventually shining through.
So as you, our listener, reflect on these timeless lessons from Graham, the big question becomes, how will you choose to act in the face of this inherent market uncertainty?
The choice point.
Will you succumb to those often overwhelming forces of fear and greed? Will you let Mr. Market, with his wild mood swings, dictate your decisions and jerk your emotions around? Or will you choose the deliberate, the principled path of the intelligent investor? Building your future not on fleeting trends or emotional whims, but with patience, with disciplined analysis, and with a steadfast commitment to value and that all-important margin of safety.
The decision ultimately is yours,
Yeah.
and it really will define your entire investment journey and likely your long-term results.